On April 23rd, 2026, the company that owns Instagram, Facebook, and WhatsApp posted a quarterly profit of $22.77 billion. That is not a typo. $22.77 billion in a single quarter, the most money this company has ever made in 3 months. Revenue for that same quarter was $59.89 billion, up 24% from the year before. That same day, the company announced it was firing 8,000 people. Welcome to The Pulse from 10-Minute Money Mindset. This week, Mind Over Money examines the psychological bias that makes a layoff hit harder than the math says it should. But first, The Pulse has the story itself. 8,000 jobs eliminated inside the most profitable quarter in company history. What that means for you, even if you have never worked at a tech company. Let us get into it. You are listening to The Pulse from 10-Minute Money Mindset. Every Monday, we report the week's most important financial story. Sourced, named, and without spin. This is the story of what happens when a company posts its most profitable quarter in history and fires its employees to pay for the future. And why everyone listening should be paying attention, even if you have never worked in technology a day in your life. The memo arrived in inboxes across Meta's offices on Thursday morning. It was written by Janelle, Gale, Meta's chief people officer. The tone was measured, almost clinical. She wrote that Meta was cutting 10% of its workforce, 8,000 employees. The layoffs would take effect on May the 20th. Another 6,000 open positions the company had intended to fill would be eliminated before anyone was hired into them. 14,000 jobs, gone or never arriving in a single announcement. She acknowledged the news was hard. She called it unwelcome. She wrote that confirming the layoffs now was the best path forward, given the circumstances. She did not specify the circumstances, but Mark Zuckerberg had. Back in January, on Meta's quarterly earnings call, he told investors that 2026 was going to be the year that AI starts to dramatically change the way that we work. He said the company was already seeing projects that used to require big teams now accomplished by a single very talented person. That was January. This is April. Let us be precise about what Meta is doing with its money, because the numbers tell the story the press release does not. In 2025, Meta spent $72.2 billion on capital expenditures, data centers, AI chips, the physical infrastructure of machine intelligence. In 2026, that number is expected to climb to between $115 and $135 billion, more than the annual economic output of most countries on Earth. 8,000 jobs is, in part, how the company pays for that bet. The cuts fall hardest in specific places. Meta's Trust and Safety division, the team responsible for reviewing content across its platforms, has seen significant reductions. AI moderation systems now reportedly meet or exceed human accuracy rates across most content categories. The machines are better at the job, so the humans who did it are no longer needed. This is not speculation. It is the stated direction. Zuckerberg has been explicit. Gale's memo called it offsetting other investments. Different language, same sentence. Affected US employees will receive 16 weeks of base pay plus 2 additional weeks for every year of service. It is among the more generous severance packages in the industry. It does not change what it is. Here is what the data says about the workers who remain. Daniel Zhao is the chief economist at Glassdoor. He tracks the Employment Confidence Index, which measures how secure workers across industries feel about their financial and professional futures. In March of 2026, the technology sector posted the steepest year-over-year drop in confidence of any industry in the country, down 6.8 percentage points to 47.2%, below 50 for the first time, meaning more tech workers now feel uncertain about their jobs than feel certain about them. And here is the detail Zhao flagged that most coverage skipped. Fewer workers are quitting voluntarily right now, not because things are good, because they are afraid to move. The market feels unstable. Staying feels safer than leaving, so they stay and they wait. Meta is not alone in this story, not even close. Amazon has cut at least 30,000 corporate and tech jobs since October of last year. Microsoft announced this week that it is offering voluntary buyouts to approximately 7% of its American workforce, the first buyout program in the company's 51-year history. A company that has existed since 1975 has never done this before. Snap cut 16% of its workforce in March, citing AI-driven efficiencies. Oracle has eliminated 30,000 positions globally since the start of 2026. Block, the fintech company behind Cash App and Square, cut 40% of its entire workforce in February. Its CEO issued a stark warning alongside the announcement. More companies, he said, would follow. Nike announced this week it was cutting 1,400 more employees, mostly in technology. Alphabet, Microsoft, Meta, and Amazon are expected to spend a combined $650 billion on AI infrastructure in 2026. They are simultaneously spending more on building the technology that replaces workers while eliminating the workers the technology is replacing. The tracker site layoffs.fyi has counted 92,000 tech workers who have lost their jobs so far this year. 864 per day. Since 2020, the total stands at nearly 900,000. 900,000 people. That is not a statistic about an industry. That is 900,000 individual decisions made when the job felt permanent. Mortgages calculated against a salary that no longer exists. Car payments budgeted from a compensation package that disappeared in a Thursday morning email. College savings built on stock grants that will not vest. 900,000 people who built their financial architecture on something that turned out to be load-bearing in a different way than they thought. And the rate is not slowing. 864 jobs per day in 2026, up from 674 per day in 2025, more tomorrow than today. There is a version of this story where all of this is transition, not collapse, where the people laid off from content moderation roles find new work in AI-adjacent fields, where the economy creates jobs we cannot yet name. That version may still happen. Anthony Tuggle is an executive coach who has worked inside large corporate restructurings. He described what is happening in tech right now as a fundamental structural shift rather than a temporary market correction, not a correction, a change. There is also a complicating detail worth noting. OpenAI CEO Sam Altman recently coined a phrase for something he has observed happening across the industry. He called it eye-washing, companies blaming artificial intelligence for workforce reductions they may have been planning to make regardless, using the language of progress to justify cost-cutting that is as old as business itself. Maybe some of what we are seeing is AI washing, maybe not. The motivation is genuinely unclear. What is not unclear is the number. Meta reported $22.77 billion in profit last quarter, the most in its history. Revenue up 24% year over year. And on the same day that number was circulating in the financial press, 8,000 people received a memo telling them May 20th was their last day. The company is not struggling. The company is choosing. That is a different story than the one most people are telling about this. And it is worth sitting with until Friday, this Friday on Mind Over Money. The same paradox examined from a different angle, why most of the 8,000 people who got that memo did not see it coming. Even though the signal was there in January on a public earnings call, in the CEO's own words, the name of the psychological pattern that makes warnings disappear, and what it means for how you are thinking about your own income right now. That is Friday. Subscribe so you do not miss it.